Hello, everybody, and welcome to our webinar, FASB Fact versus Fiction. This should be really fun. Obviously, there's been a lot of movement in the FASB space recently, given the new guidance. We are here to talk about that, talk about how our lives are going to change, talk about the good stuff, the bad stuff, and everything in between. My name is Pat. I'm the CEO of Bitwave, and joining me today is Zach Gordon from Propeller and Joe Dillon from Bitwave. Zach, you want to introduce yourself?
Absolutely. And Pat, thanks so much for having me here. This is always fun to nerd out a little bit. I'm Zach Gordon. I'm VP of Accounting with Propeller Industries. I've been a CPA for about 15 years, worked in public, worked in private equity. I've been a startup founder myself, going through all the trials and tribulations there. I've been working in crypto since about 2016. And speaking of trials and tribulations, there's maybe one or two fun and interesting things to talk about.
just to keep our lives interesting.
Exactly. Why be boring? Obviously, with FASB coming out with this draft, it leaves quite a few things for us to talk about. So I'm really excited to dive in.
And for anyone who doesn't know, can you tell us about Propeller really quickly?
Absolutely. Thank you. Propeller has been around for about 15 years, and we are a firm focused on outsourced CFO and accounting services. We typically work with VC-backed and pretty exciting startups, tech companies, obviously crypto on the blockchain, amongst a few other industries. Everything from full-on outsourced CFO services, the back office, to transaction advisory, and pretty much everything in between.
Awesome. Zach, thank you so much. Thank you for being here. Joe, great to see you, buddy. How are you doing? Tell us about yourself.
I am doing great. I'm Joe Dillon. I'm our Director of Customer Success over here at Bitwave. I work with a lot of folks like Zach and other people, using Bitwave to get their digital asset, accounting and bookkeeping done. I come to Bitwave after a bit over a decade in public accounting. So I'm a CPA as well, which means, I've been excitingly reading the FASB exposure draft.
And Joe, why don't you tell us about Bitwave real quick?
Sure. Yeah. I mean, Bitwave is Bitwave is an enterprise digital assets, accounting and tax platform with, we think about ourselves as enabling enterprises to use digital assets. The accounting, the bookkeeping, the tax work is kind of maybe the first stage of that, and then people also use Bitwave to track their balances, do some other kind of fun stuff. But first and foremost, we are an accounting and tax platform that enterprises use for their digital asset activity.
Amazing, thank you, Joe. All right, well, let's dive into it. So Zach, let's really quickly. There is this part of this all that I've enjoyed, which is So we said when we were prepping for this webinar, we talked about how this is a day for nerds, and this will continue to be a day for nerds. There's actually this really technocratic part of this, which is that I've been very interested of, which is the way it's there's that Schoolhouse Rocks for how a bill becomes a law. Like how does a FASB a fever dream become a FASB guidance officially used by GAAP? And where are we in that process today?
Yeah, so that process started ages ago, and FASB itself, the board is, it's comprised of some of the more, the best qualified technical professionals in the country. However, I'm not sure if you guys have heard this before, but accounting doesn't move quickly. So it's taken quite a bit of time, and it's taken a certain level of, market movement, let's say, and a certain amount of scrutiny and attention to get this higher up on the priorities list. So it's taken quite some time for us to get even this far. So where we're at today is, in fact, we took the time to interview dozens, if not hundreds, of professionals, both in industry and those like us as well that work around industry, to give them the suggestions, give them the opportunities, the pitfalls, etc. Areas where we really need further technical definitions. We need guidance. We need a set standard. And where we are now is a draft. So they've taken all those ideas, they've ignored 89% of them, and they've come up with it, kidding, of course, to FASB board if they're watching, but we've gotten to a point where they've given us what their recommendations are for what this infrastructure should be. And we have until June to then respond to them. And they'll take in any responses and move that into the process.
Yeah. So after, what happens after June? So they'll get a bunch of comments in. June comes. What's the next step? Do they do another exposure draft, or is it they integrate what they want, leave alone what they don't, and issue a final? I guess would this end up being an ASC of some sort, ASC for digital assets? Like
That's right. That's right. So unless there is just absolutely wild feedback, it's then moving on to that step where it's officially codified. And while I think all of us are forward looking, you just never know for sure what will actually become codified. So at that point, then we need to make sure that any sort of proactive steps are actually in line with what's released.
Yep. And so, Joe, tell us a little bit about. So first of all, Joe, you've read all the different drafts, and I won't force you to remember them all, but kind of tell us where we are today in terms of the various drafts. Tell us anything that stands out in your mind as what's changed, what's been clarified, because this is the third version that I think we've all seen, at least the second, but I think we heard rumblings. We got like kind of first set of notes. We saw a first exposure, second exposure now. What is changing overall? What has changed over the different drafts? How are you feeling about it?
Right. Yeah. So I think, what you're referring to, Pat, is like FASB has been having these votes. They have these votes, they document these processes because, as Zach mentioned, this has been a long time coming. So they've been kind of voting on some of the provisions that they expected to be in this exposure draft. And so now we're finally here. So I think, I can't remember. I think it was last fall, maybe in October or November.
You hit it on the head. Yep.
They did that vote of, okay, fair value accounting is coming, and then they've had some other votes, and so this exposure draft kind of puts it all together, and it is that big piece. I think my two biggest takeaways with this exposure draft is, one, fair value accounting. I mean, that's the big headline. Today, accounting for digital assets, they typically get treated as indefinite life intangible assets, which means under today's rules, you're recording them at historical cost, and then you're impairing their value down if the value does go down.
And by definition, that means it can never go up in value.
Go up, Zach, which, maybe you could talk to for a moment about why don't people in the digital asset accounting space like the current model? Why is fair value
and not just the digital accounting space, but even, I mean, accounting fundamentally is a tool to tell people how much money you have and how much money you're making, and that the impairment model kind of is creates issues there in some ways. Zach, why don't you tell us? Yeah, Zach, tell us a little bit about what impairment means today, and then we'll kick it back to Joe to talk about how that changes with fair value.
Perfect. Yeah. So at the deepest fundamental level, the balance sheet is supposed to tell the financial story. So where your assets are, your liabilities, your equity, and you can see over whatever period of time, like, oh, it started here, it went here, and you're able to put together the story, as it were. Well, with impairment and not being able to mark to market, at least going up, at that point, you have a really confusing story. Because, I mean, let's just say you have crypto assets, and it doesn't matter what they are; they're crypto assets. You buy them for $1 million. That's the amount that's going onto the balance sheet. Well, I don't know if everyone's familiar, but there's some volatility in this industry, a little bit. So it goes down to $500,000 at some point. So you impair the value of those assets down to $500,000. Well, then things go back on the upswing, and now it's worth 1.2. Except you can't represent that on the balance sheet. That's not proper GAAP accounting. So you still have that $500,000 instead of the 1.2. Now, as accounting professionals, and especially as a platform like Bitwave, where you want to be able to tell that story and be able to reconcile to what the wallets say, it doesn't always get there.
Well, and a great example of this is over the last 2 weeks, we had USDC hit 88 cents. Mm-hmm. And so basically everyone who is and like USDC is going to come up over and over and over again through this conversation, because the two things that this really create complexity around is stable coins and then wrap tokens are another big conversation here. But USDC is a great example of where most people, a lot of our customers, treat it as cash equivalent. It gets put into a cash equivalent. Everyone's just like, hey, this is cash equivalent. This is cash. But 2 weeks ago, it went down to 88 cents. And so everybody that's sort of been, hey, this is cash equivalent, is something like, crap, should we have been doing a actual impairment model on this? Because obviously it's not pegged to the US dollar. And then if you take that to the next level, which is to say everyone who's sitting on USDC is suddenly just took a 10% haircut on their book cost, even though for all intents and purpose, it is a cash equivalent. I can go to Circle, I can turn all my USDC in for one-to-one for cash. And that creates a lot of complexity. And I think probably like more so than anything, it just creates a lot of footnotes. Like it just means that you're not reading a balance sheet, you're reading a narrative around footnotes and then looking at the balance sheet.
That's a great call.
Yeah.
As a former financial statement auditor and occasional financial statement preparer, the footnote, the industrial footnote complex does keep keep the likes of CPAs like me employed. But you're right. I mean, what happens is this momentarily decline in value all of a sudden like locks in that value for this asset on your balance sheet forever, unless it goes down further, even though a week later, it can go right back up. So now we have a mismatch between exactly what Zach was saying. The balance sheet is supposed to tell the story, to give you an accurate reflection of what you have and where you're at. And this cost basis plus impairment model just doesn't quite hit the mark. So that then, and everyone in this industry has really been saying that pretty loud and clear. So that's where we get, fair value accounting, which you may also hear the term like mark to market, which essentially just means that on an asset by asset and a lot by lot basis, and we can get into what that means if we need to, but the accounting is moving to, instead of what you paid for it originally and then impairment, actually changing the value of that asset on your balance sheet to reflect what its current price is. So if I issue a financial statement December 31st, my assets are going to have a particular value. And then if I had a new filing March 31st, if the value has gone down, I'm going to report that. But also now, if the value has gone up, I'm going to report that. And this exposure draft also lays out where that change in value needs to get reported. So, your asset value is changing on your balance sheet. But, the other side of that movement, P&L impact, income statement impact, the exposure draft gives some guidance as to how those have to get reported.
We'll get into that momentarily. And I think it's one thing that I'll mention about that fair value is this, so impairment is not, intangible, indefinite-lived intangible assets are not new. Everyone has them on their balance sheet, whether that be domain names or whatever. What was really novel accounting was this idea of a fluid market behind it. Mm-hmm. So the example I always give is that most people will have a domain name that they bought that should be treated as an indefinite-lived intangible asset. You almost never mark your domain down unless you're Enron or FTX. Like those are the two examples of they probably are marking their domain names down, but no one else does. So this idea of an actual day by day impairment calculation is just so far off of what people are kind of used to. Whereas fair value is actually pretty common. So it's certainly common in any sort of hedge fund, investment broker, any sort of accounting that way. Really quick, are there other assets?
As you said, there's equivalents in other industries. So
are there other assets that businesses regularly fair value, or is it not super widely used for businesses themselves?
Well, it all depends on the industry. And Joe, I think you started going down that road, but it's at least, speaking as, a couple CPAs in the room, there's other market comparables where we can get comfortable. And at least we know that, through other practical engagements that we have, we're able to see an apples to apples type of situation. Whereas right now, that really doesn't exist.
Right.
So it's one of those things where you could get 12 CPAs in a room, lock the door, and you're going to get 15 different opinions and 17 different ways to go.
Yeah.
So it's one of those things that's the potential value that we're looking at here.
So let's talk about it. Okay, so the FASB draft that came out, it was pretty clear about exactly what is going to be fair valued and what isn't going to be fair valued. Joe, why don't you take us home here? What is going to be fair valued? What is not going to be fair valued?
Yeah, I think that is, and there's another point in the exposure draft about transaction fees and how those get handled. I want to make sure we touch on those, maybe after this. But I think what you're talking about is honestly the most interesting part of the exposure draft, which is what's in scope, and what's out of scope, because what's in scope is going to get fair value accounting. What's out of scope is going to get, what we have today, or if, there's other rules that apply to that particular asset. So things that are pretty explicitly out of scope, there's a handful of categories. One, they say right off, no NFTs. It has to be.
Yep.
So no NFTs. I think in the past, if you looked at some of the FASB folks, some of their quotes, I think they essentially said NFTs were not pervasive enough that they didn't feel like it needed to be addressed. So NFTs are out. No fair value accounting.
And what's amazing is the IRS opined on NFTs before FASB did, which I would have lost that bet. My goodness.
Yeah. Well, the IRS opined on a lot of this stuff early on, which was shocking. Even the FASB at this moment we were all blindsided in October when this came out. I mean, we were all pretty surprised they actually wanted to get into this barrel of worms. NFTs make sense. I mean, at the end of the day, it is there are NFTs that are domain names, so it even has an analogy to the modern day or to the current accounting. But then B, art is one of those things where it's just going to be a really tough one to get your hands wrapped around here. Okay. So NFTs are carved out. A couple other things are carved out that are really notable.
Yep. Most people are interpreting it to mean stable coins are going to be scoped out of this. Yep. And there's really in their scope section, they lay out that essentially what is they scope out any assets that have a right to or a claim on a different underlying asset. So for a lot of stable coins like a USDC or a USDT, if it's redeemable for a US dollar, then most people are interpreting this to mean those are scoped out of this.
Yep. And then that would include things like DeFi liquidity pool tokens. And then, of course, the big one that also potentially includes wrapping tokens, right?
Yep. Yeah. So they did say, wrapping tokens are out. I think it's under that same line of thinking, which is that, your wrapped token is redeemable for this other asset, and that's the true asset you should be doing the accounting for. But, it does then, introduce this world as we're talking about these carve outs of, your ETH is fair valued, your WETH is not. Yeah. And there's obviously a bigger picture conversation about wrap tokens in general, which is, when are they substantially the same asset? I think ETH and WETH are probably the strongest.
Well, and to take that thought one step further, and I've seen this argument made a couple of times, but are these wrap tokens, are they a true financial product? Are we getting into derivatives or some sort of really complex instrument here? Being careful word there.
Or is it not? Is it just literally a different interface for it? So Zach, I have a question. This I hope this isn't the hardest question of the panel here, but so sort of from a bit of a layperson's perspective here, the second they decided to carve WETH out. So one of the debates in crypto accounting for a long time has been, when you go from ETH to WETH, is that a disposal, and do you pick up a gain loss or not? And that's, everybody has a different opinion. Some people treat them as equivalent, where there's no gain loss. It's just a shape shift of some sort. Some people treat it that. The second that they decided to carve it out of this and give it a different overall accounting treatment, did FASB essentially make a choice for how accountants should treat that?
Oh, I think that became very clear that's an absolute yes, that now we are looking at what is a true taxable event. Yeah. And that just makes, regardless of the fact that you could certainly argue it's a one-to-one for all intents and purposes, it is a taxable event, which means you have to restart the clicker, and it makes for an additional level of accounting that we need to monitor and properly maintain.
And not just a taxable event, but also even if you're just tracking your gain losses on your own books. I mean, you are picking up a gain loss when you go from ETH to WETH. Whereas before, a lot of our clients did not. They treated them as structurally equivalent, and they did not pick up gain losses in that case.
Well, which brings up one area where, Joe, I'd love to get your thoughts on this too, but wash sales. And the fact it still seems like it's pretty quiet out there, where it's not against any rules that I've seen, but it's not certainly not blessed by any stretch.
Yeah, I think the way I think about this is these are all such good examples of we're getting new regulation, we're getting new rules, but all of the governing bodies are not moving in unison. So you guys already touched on it, right? You know, IRS weighs in on this part here, FASB weighs in here. And so like navigating kind of these changes is definitely going to be part of this obstacle. I think wash sales specifically, you know, some, right, nothing explicitly closing there. There is, you know, a tax, I think it's called the economic substance doctrine.
Yep.
that some hardcore tax pros I've heard make the case say that wash sales fail to meet the economic substance doctrine. So they would say they're actually disallowed already, but I've seen the opposite argument being made due to the volatility of markets in itself, that crypto is risky, and you know, a wash sale
Wait,
is
what?
inherently
Risky?
or like, I know this has been like, to me, the quickest shortcut to a wash sale is just swap to a wrap token. Okay, if you're saying the wrapped token,
now they're explicitly saying that that's okay.
If they're saying the wrap token is different, then okay, then I'll just swap to the wrap token. It mirrors the price, and now I've effectively sold my asset. I want to call out one other thing that's scoped out that I haven't seen quite as much discussion of, which is the asset issued by the reporting entity. So that would be, you know, in dealing on the enterprise side of the digital asset space, we see this all the time. Like tons of our customers issue their own token. And so that is scoped out of these rules, right? So that those would not get the fair value accounting. So we've got NFTs, stable coins, wrapped tokens, and then, you know, anything issued by the reporting entity. We have
Joe, did they give examples of issued by, like, let's take the Solana Foundation. Is Solana issued by the Solana Foundation, or are mine tokens like carved out of it? Or was there any guidance given around there? I know that's like a hard question, but was there any guidance given around there?
Great question. I don't think they had specific guidance. Maybe Zach will correct me here, but I think what you're like highlighting is like
The continued
all the time in
ambiguity.
digital assets, which is they are not all created equal. Every single one needs to be evaluated on its own circumstances. If, you know, Joe Crypto Inc., I issued the Joe token, it may very clearly be scoped out, where something like you're saying, like a mine token, did the Solana Foundation issue that, or did they not? You know, each one of these, I think, really has to be looked on its own separate set of facts.
So
Zach, and to make that even more complicated for any native tokens, is there an acceptable market value? You know, what volume are we talking about? Can you go to coin, pick your favorite exchange or wherever and take a look? Like, is there an acceptable valuation?
Yep. So Zach, take us through. Joe started to touch on it, but let's have you bring this home here. Take us through the actual account when you're doing a fair value on a token like this. Take us through the actual accounting. How often are you revaluing it? Are there specific rules? Are there ways that you're going to make that decision? Do you have to be consistent? Like, do high movement periods create additional needs to revalue? Like, walk us through how you're actually doing the fair valuing, A, and then B, talk about what the other side of those transactions, those journal entries are. Let's get into the accounting nerd part of this. Let's get into JE.
Here we go. So, like all great accounting questions, it depends. But no, here's where it gets a little interesting. And Joe, correct me if I miss anything here, but the way I read this is anytime you issue financials, that's where you need to have that impairment done historically, and that's where we need to mark to market up, down, or otherwise. So if you're issuing quarterly, there you go. If you're issuing annually, follow that cadence. And where I like to get a little annoying, and I use this word way too much, but documentation. So making sure that you have everything properly documented, and that's not only the financial aspect, but that's the process element as well. And that's where I know you guys do a great job, and it's, makes my life a little bit easier knowing that, we understand the process on the platform, and then that just extends to our own in-house processes as far as actually producing the financials as well. So that's where, while we keep a close track of it on a month by month, week by week, day by day basis, where you actually need to reflect is when financials are actually issued. And that I think is actually very fair, because it does take a slight bit of ambiguity out, because to speak frankly, we get asked that question all the time, especially onboarding a new client, or knowing that FASB's out here doing what it does. There's a certain level of concern if you're trying to issue financials and there's a little lack of clarity.
Silly question, but that would be different than most hedge fund accounting or trading accounting, where you're basically marking on a daily basis. Yep. So we're sort of saying, hey, we're going to carve this out where we're going to mark it on a only on a reporting period basis, which actually is not all that often usually. I mean,
correct.
I mean, that's probably annually for most companies, quarterly for public companies, essentially.
Yep, pretty much. Unless you have some really unique and interesting covenants that you have to maintain, where we've seen cases where monthly financials have to be issued. Try to avoid that wherever possible, but
well, I guess so that would be if you had a reason you were doing monthly financials to your board or something else, then maybe something like that. But for the most part, so it's anytime you're issuing your financial statement, essentially, is when you're doing it. That's really, really interesting. Are there weird knock-on effects of that? I'm trying to think, just because the way we do, the way we've been doing impairment, where you're picking it up every single day, is very different. But I guess with fair value, it doesn't matter, right? Because even if you're fair valuing every day, it's exactly the same. If you do it 10 times, you do it once, it's the exact same, right?
Right.
It gets you to the same endpoint. It's just a matter of and how often you're going through that level of process.
Got it. And what's the other side of the JE? So I think that's one of the interesting questions here, right?
Yeah. So and this is where the exposure draft gets pretty explicit from a reporting requirement. They say, straight up, gain or loss from changes in fair value need to run through the income statement. So the other side, you're changing that asset value on your balance sheet. The other side is going to go to some gain loss P&L account that flows right through your income statement. So that's going to be the other side of that journal entry. And then to Zach's point about documentation and reporting, I think, they're very specific about what needs to be reported. So like for annual and interim reporting, they say straight up, name, cost basis, fair value, number of units of each asset. You need to report that for all your, what they could call significant crypto asset holdings. And then you can aggregate.
And then the other category.
Aggregate for the other, right? So definitely some ambiguity there of what is in that other bucket. And then for annual reporting only, they specifically say that you need a roll forward, which shows additions to that asset, dispositions, gains, losses. So a true roll forward. So it's at Bitwave, we like that, right? Because that's what we do, right?
We got one of those. We got one of those things.
Nailed it.
Right. But it's that data focused mindset of like, it's not just about getting to the end number. It's having that documentation support of exactly how you got there. Where were you at the end of last period? What's everything that happened between now and then, and where you end up. And the other kind of interesting carve out from a reporting standpoint is that they specifically talk about assets subject to restrictions. I read this to mean locked tokens, and
vesting tokens, staffs, that kind of thing.
Yep.
Yeah,
exactly. And so they do want you to report those are also going to get fair valued, but there's some additional disclosures required, like the nature and remaining duration of those restrictions. So now tracking. I think, most of our.
So they're not doing a discount model in it. They're doing a fair value with disclosure as opposed to some sort of discount model.
I'm pretty sure that they've talked about the fair value. I think that's what the exposure draft says.
Yep.
But with these additional disclosures. So now it takes those like kind of locked token tracking, and if you have SAFs, I think most entities we see are tracking what's the most common way when they come in the door at Bitwave? It's in Excel, right? But now this adds another lens of maybe scrutiny to those, and definitely to me increases the importance of really.
Well, and you get, it's like even more complex left hand, right hand kind of stuff, because you're fair valuing on your books, but you need to make sure that disclosure gets picked up when you hand that over to your financial statement preparer, which is not always the easiest thing to do if you're dancing around it. That's interesting. We'll have to. There's probably a feature there for Bitwave to do some more.
I would say so, and Joe, I think you hit it on the head before, where this is continuous employment for those of us who
Yeah.
put together financial statements, analyze them, add all the footnotes, all that stuff. Like that's now become 101 level service delivery.
Yeah.
And yeah, it's
Zach,
good for
take
us.
us home here with Joe mentioned this, but you close it out. Fees. So whether that be network fees or trading fees and commissions, there were some changes there that were going to be really, I think that were probably one of the more surprising notes for everybody. But yeah, take us home on the fee side.
Well, the fees. So for fees, what we're splitting those out specifically.
Yeah.
Yeah, exactly. And now they're not, because we see folks take two standpoints typically at Bitwave. Either you're expensing your fees as they're incurred,
yep,
or you're capitalizing them. So if you have a gas fee to acquire an asset,
yep,
a lot of people capitalize that into that starting
yep,
cost basis of that acquired asset. They pretty explicitly say here, no more. Exactly right, Zach. So what does that look like now? If I can't capitalize, what am I doing?
Oh, so and this is where it gets interesting, because I never actually agree with capitalizing to begin with, and that's where we can get into some philosophical debates here, accounting wise. But I actually like that FASB dropped the hammer on that, because I do think it gives a more true picture to what the actual cost basis is, and getting into gas fees. I don't know if that really told the truth.
You include even trade. If I was on an exchange and I was trading, you included even that you wanted to see that fee, that commission capitalized as opposed to.
Oh no, I don't want that.
I'm sorry. You want to see that commission expense not capitalized? That's interesting. Exactly. That's super interesting to me, because I would have thought that was just a very equivalent to a securities world. What was give us a little insight? Like, I love it. Like, I love the discussion. What was your original thinking around there?
Well, it's related to the specific transaction in time. So it's the access to whatever that transaction is at that particular moment in time. And just philosophically, it always just sort of made sense to me that, well, this is a transaction at a moment in time, and regardless of the type of transaction, the specifics of that transaction, the fee happened. It's your right to access the gateway, so to speak, and that sounds like a period cost to me.
Got it. Okay, so that's going to be a big one. So that's and let me. So I have a question here that hopefully we can maybe call this the last question. But so if you take something like this, which is a move from a lot of our customers capitalize fees to now not capitalizing, we support both. It for what it's worth, it muddies up your books a lot, because you go from every trade being like, basically the way before this sort of decision, trades don't hit your books, right? Trades are it's net neutral to your books because you're capitalizing the fees. Now suddenly every trade you have to book the expense. So you have a pretty substantial and that's a lot. It's a pretty substantial movement there. So we have this movement from capitalizing to expensing fees. We have this movement from impairment to fair value. What is the restatement period going to look like? Did they give any guidance on that? Can you guys speculate on it at all? I mean, this is like no financial advice or anything like that. Obviously, this is that we should have said that at the beginning. This is not financial advice. Seek your own accountant or lawyer. But what are you going to have to restate any assets that you have capitalizing fees? You'll have to go back and restate those financials. Will you have to? When you move from impairment to fair value, that's for a lot of companies a windfall. I mean, for someone like Tesla, that's $130 million windfall. What is this period of restatement going to look like, or methodology change? Zach, maybe start out.
Well, one thing that stood out to me before we dive too deep into that is they're telling us to touch retained earnings, which I was all like, I just feel wrong even having this conversation about it, because that's a 101 level no that you shouldn't do. But yes, there is a prior period adjustment you have to do, and it's recommended booking that against retained earnings, which is just an area for debate, and I'm sure that'll get brought up on response letters and such. But Pat, I think you did a good job of outlining what some of the major areas are where we'll have to start taking a real look, and that's where making sure that you have that nice clean data going in at the transactional level, so that you can start to split out anything that might have been capitalized, making sure you have a good understanding of what the true cost basis is, and you can start to go through the detailed process. But yes, there is an adjustment that will need to be done for the beginning balance of whatever your appropriate either interim or reporting period is.
Right.
So that's
that's the cumulative adjustment, right, Zach? So it's moving from your old methodology to your new methodology.
Yep.
The cumulative impact, you run that adjustment through retained earnings
instead
of restating everything prior historically. So I am curious.
Sorry, Joe, that includes, so the movement from impairment to fair value goes into retained earnings.
Yep.
The capitalizing, all this is going to be booked into retained earnings. Okay.
Yeah. All this will boil down to an adjustment that they're saying, put it through retained earnings instead of restating everything prior, which I am curious to see what comments they get. Cause Zach, like you, a lot of time, anytime you're booking something directly to retained earnings, it's like, is this really what we want to do? But I think it will save a lot of these entities from having to restate,
and that's of course the goal. It's the impact, as it were.
Yeah.
Because think of that gets really expensive, time consuming, and just messy in its own right. But
and just kind of silly, at the end of the day, like everyone was sort of doing their best job. Now that we finally have guidance, like, okay, let's get healthy as quickly as possible, essentially.
Right. And it's a shortcut to get there, which, if the authority is the one blessing it, I guess it just flash to the early years of public accounting where that would never fly.
I'm with you. And as far as timing, Pat, so they're collecting comments now. When this comment period is over, essentially, I'm not sure exactly what the exact timeline will look like, but they'll essentially put an adoption deadline of like, you must adopt it for any reporting periods at this point. And then they'll typically allow you to early adopt. I do think this will be one. I don't know when they're going to set that deadline. I think we're going to see folks early adopt the heck out of this.
And I know we're pushing for that. So that's
Oh, that's interesting. Yeah.
Well, because it's not a bad. This is not this for most people will not be particularly punishing. This should be a relatively good. This actually should be relatively positive on their balance sheets in some ways. I can't.
Yeah, I mean, going through the last. After the last year or so of down only.
Exactly.
There might be some people eager to write these back up, but then there's also an element, maybe a bit of gamesmanship from reporting. Do we want to book this big positive adjustment in the current year, or do we want to wait? So there's definitely, it's not always as straightforward as far as early adopt because this is good, value goes up. There is some thinking around that, but that's why you hire folks like Propeller to walk you through what all those considerations are.
Oof, how about that plug? But you're a little gamesmanship, and this is something where on a case-by-case basis you model it out to see when is it most advantageous. So you hit it right on that.
Yeah. Any other thoughts? Anything? Oh, we should talk very briefly. I know we're bumping up on time here, but we should talk very briefly about the wrapping treatment here. Is this so? As you basically are going to now sit on wrap tokens versus unwrapped tokens, and one will have to be impaired, one won't. Is there even a world where this starts to change people's behaviors and stuff? I mean, basically getting out of wrap tokens as quickly as possible, not sitting on them, staying in the base currency, all of that. Like any other knock-on effects?
That's really interesting. I think so much of the ethos of the crypto ecosystem is to do things and figure like the accounting out afterwards, right? So thinking about
you don't have to tell me that.
but right. Yeah. I'm sure it. You live it every day. But it's really common in other industries for reporting and accounting guidance to actually drive operation, decisions. And I think this could be one of those times where we start to see the impact of that. I think I'll make my closing point here, which is just this is the start of this bifurcated world where different digital, this world of all digital assets are this big lump bucket and they all get the same treatment. That's gone. We are definitely going to see different assets get different treatments from a GAAP perspective, marrying that with equally as different treatments on the tax side of things. This is, really what I view as this first wave of changes we've all been kind of anticipating. And now I think the requirements from an accounting and bookkeeping and reporting standpoint, they just get a lot more technical, right? This is where you have to leverage the expertise of professionals in the space. And here's my plug for Bitwave, and utilize a system that facilitates that, right? From a data perspective.
Absolutely. Zach, bring us home, buddy. Any other kind of final thoughts? Things are going to be a little bit weird for the time being.
Weird is always a great word, and somehow unfortunately appropriate in this industry. But no, I think, Joe, you made some fantastic points there as far as being in this transitionary period where we're starting to get some answers. And I think that's a big deal, whether we like them or not. And there's a ton of debate. I think it makes us sleep even a hair better, knowing that there's at least some semblance of a framework. And
the discussion is happening at the high levels. Yeah,
exactly. And to take that one step further, and Joe, again, I think you were hitting this on the head, but on one hand, having a platform, so making sure that you're aggregating the right data, that you're putting it into a form that is usable, that can not only sort of tell that financial story that we've talked about a little bit, but then can actually be useful from a compliance, from a reporting perspective. And then working with the right people and asking the right questions as far as how are we using this data, how does this fit into the framework that is being put together here, and then hopefully continuing to ask the right questions so that we can continually improve and try to wrap our heads around this crazy industry.
Well, spectacular. And I'm sure we'll get a chance to do this again when the next round of guidance comes out, either for this one or as more clarity comes to, derivatives and the stable coins and all these other crazy things that we're kind of dealing with here. Zach, Joe, thank you guys so much for joining us. This was absolutely spectacular. Really, really fun. Good conversation. Hopefully a lot of actionable guidelines. Go out, everybody, and may start making your journal entries today. And we will, I'm sure we'll be back to talk about this once it becomes official. Thank you guys so much.
Awesome. All right. Thanks, guys.
Awesome. Thanks, everybody.